Good morning and welcome back to the Daily Hunt for Multibaggers on this Thursday, February 19th, 2026.
We've had quite a busy 24 hours in the market, Ethan, with our AI sifting through a substantial amount of data. It flagged no less than 18 different stocks for discussion today.
That's right, Brooke. The chatter is definitely picking up. And while we're seeing some exciting growth stories emerge, there's also a significant undercurrent of caution out there. It feels like a market of extremes, you know? A lot of strong opinions floating around. First up, Palantir Technologies, symbol PLTR. We're seeing some real buzz here, with one user actually boasting about a 10x gain on PLTR calls, driven by a belief that tech was oversold. Analysts are revamping ratings, calling Palantir an AI heavyweight, even in a category of one, Brooke. They're highlighting its immense AI growth potential, and we're seeing partnerships like the one with Rackspace. The net profit margin is an excellent 36.31%, and revenue growth looks strong at 70%. That's a powerhouse in the making, wouldn't you say?
Well, Ethan, while that 10x gain is certainly impressive for one individual, it also screams high volatility, confirmed by PLTR's beta of 1.687. The market commentary is actually quite mixed, leaning slightly bearish in some discussions, with users expressing a general dislike for the stock. And let's talk about the valuation. A price-to-earnings ratio of 211.53 is, frankly, astronomical. That means a huge amount of future growth is already priced in, leaving very little margin for error. Plus, we've noted relatively high debt, and insiders have been net sellers over the last 6 months. Our previous AI-generated insights for Palantir have largely been stay away. Despite the AI hype, the risk-reward for the average investor is just too skewed here.
So even with all that incredible AI potential,
for now, the AI-generated insights lean towards caution. Our final verdict for Palantir is stay away.
All right, moving on to Coinbase Global, Coin. Now this one's got some real movement. While a lot of the social media chatter is bearish, seeing it as a proxy for Bitcoin, there's a fascinating contrarian signal. Insiders have actually been net purchasers of over 650,000 shares in the last 6 months. That's a significant vote of confidence from those closest to the company, indicating they might see some undervalued potential in the long term.
Ethan, I hear you on the insider buying, and it's definitely a point to consider. But the overarching sentiment flagged by our AI is decidedly bearish. Users are betting on Bitcoin to crash further, and with Coin's negative revenue growth of negative 0.222, its core business of trading fees is contracting. It's also incredibly volatile with a beta of 3.703, amplifying any market downturns. The stock is already significantly down from its 52-week high, and we're seeing reports of an earnings miss and strong sell ratings from some corners of the market. Our previous AI-generated insight was a buy back in October 2025, but the landscape has changed considerably.
So the insider moves aren't enough to sway you from the current market dynamics?
Not right now, Ethan. The risks, especially the negative revenue growth and high beta, are just too prominent for new money to consider. Our AI-generated analysis suggests stay away.
Next up, Western Digital, WDC. Now, this is a story I love to see. We're talking about a company that has literally sold out all of its 2026 hard drive production due to massive demand from AI data centers. That's a clear signal of robust future revenue growth, you know? The stock has surged from around $50 to almost $310 in the past year, and it's trading near its 52-week high. Plus, insiders are buying. This is pure growth potential, meaning undeniable demand.
Well, Ethan, I can't argue with those numbers. A 35% net profit margin and a 41% return on equity are incredibly strong. The company is actively restructuring, selling off its SanDisk stake to reduce debt and focus investments squarely on AI storage, which is a very smart strategic move. While the PE ratio is around 28, it's understandable given that incredible growth trajectory and future revenue certainty. The market momentum is clearly bullish, and our previous 2 AI-generated insights in 2026 were both buy. This looks like a solid play, even with a relatively high valuation.
Agreed, Brooke. This seems like a clear candidate for future growth. Our final verdict for Western Digital is buy. All right, now let's talk about Carvana, CVNA. This one's generating the most chatter by far with hundreds of posts. And sometimes that chatter can signal a turnaround. We did see some headlines about them topping Q4 earnings and revenue estimates, so there are some operational improvements there.
Ethan, with all due respect, the consensus is overwhelmingly bearish, and for good reason. The AI-generated analysis flags it as very bearish across the board. Despite those top-line beats, the stock tumbled over 20% after Q4 results due to an adjusted EBITDA miss and disappointing guidance. Users are calling it a scammy house of cards, predicting it'll go to $10. And when you look at the KPIs, it's stark. A debt-to-equity ratio of 192, a PE of 81, and a beta of 3.57. That's extreme financial leverage, massive overvaluation, and wild volatility. Oh, and insiders have been net sellers of almost 20% of their shares in the last 6 months. Our previous AI-generated insights have almost consistently been stay away or speculative gamble.
So those revenue beats really couldn't paper over the cracks, huh?
Not in this case. The financial risks are just too substantial, and the market reaction confirms it. Our verdict for Carvana is a firm stay away.
Finally, let's look at Oklo Inc., OKLO. While there's a lot of, shall we say, skepticism from users about its long-term product timeline, there are some undeniably intriguing points. Wall Street actually gives it a moderate buy rating, and there's buzz about a meta-nuclear deal, highlighting long-term growth potential in the nuclear sector. But here's the kicker, Brooke. Insiders have been massive net purchasers, buying over 26.5 million shares in the last 6 months, representing nearly 88% of total insider shares held. That's a huge vote of confidence, signaling that those closest to the company believe in its future.
Ethan, that insider buying is definitely a powerful signal, I'll give you that. But let's be realistic about what we're looking at. Oklo currently has zero revenue, zero net profit margin, and a negative EPS. Users are describing it as no hope, predicting a product by 2050, and even calling it a pump and dump after it crashed from a 52-week high of $193 down to its current $67. An 8.7 price-to-book ratio with no earning indicates a purely speculative valuation. While the nuclear sector has long-term potential, and insiders are clearly bullish, this is a company in its very earliest stages, with immense execution risk and no current financial fundamentals to back its market cap. Our previous AI-generated insights have been quite mixed, ranging from stay away to cautious buy.
So it's a long game then.
An extremely long and high-risk game. For the average investor, it's just too speculative right now, despite the insider confidence. Our verdict for Oklo is stay away. Investigate as buy. Western Digital Corporation, WDC. Investigate as cautious buy. None. Investigate as speculative gamble. Oklo Inc., OKLO.
And that's all the time we have for today's Daily Hunt for Multibaggers.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for joining us. We'll be back tomorrow with more AI-generated insights to help you navigate the markets.
Happy hunting.